Hi everyone, welcome back to my channel. Today I'm excited to share another insightful video on accounting basics. In this video, we'll be diving deep into the elements of the income statement. This video is especially beneficial for bookkeepers, accounting students, and even school leavers looking to understand the foundational principles of accounting. It's also packed with advanced insights for those preparing for ACCA or ACA exams. Whether you're just starting or looking to refine your knowledge, this video covers it all. With the rise of advanced bookkeeping software like QuickBooks Online, Sage, and Xero, the process of bookkeeping has become highly automated. However, while these tools simplify the process, understanding the key components of an income statement is crucial. Without this knowledge, there's a risk of posting financial data incorrectly, leading to incorrect financial statements. Mistakes in recording transactions can not only result in financial misstatements, but can also invite inquiries or investigations from tax authorities. For instance, not every outflow from a business should be classified as an expense, and similarly, not every inflow is necessarily revenue or income. By the end of this video, you'll have a clear understanding of how to properly classify transactions and avoid costly mistakes. Let's explore the income statement, also known as the profit and loss statement, which is a critical document summarizing a company's revenue, expenses, and profits over a specific period. It offers valuable insights into the performance of the business and helps various stakeholders, such as tax authorities, shareholders, and employees, understand how well the company is performing. Revenue, or sales, refers to the total income a business earns from selling goods or providing services within the accounting period. It's important to note that revenue does not include items such as VAT refunds, corporate tax refunds, money deposited by directors, proceeds from the sale of fixed assets, for example, vehicles, buildings, or machinery. These items are not part of the day-to-day business activities and therefore should not be classified as revenue in the income statement. Revenue should include sales of products, service fees, and commissions earned. It's important to note that VAT-registered businesses report revenue excluding VAT. Cost of goods sold, or COGS, also known as direct costs, represents all costs directly related to the production of goods or services, such as raw materials and labor. For example, this includes the cost of raw materials, direct wages, and factory overheads. Also remember to add the opening stock and deduct the closed stocks from inventory when working out cost of goods sold. Gross profit is equal to revenue minus cost of goods sold. For instance, if revenue is £100,000 and cost of goods sold is £40,000, gross profit would be £60,000. Operating expenses include overhead costs like rent, marketing, and employee salaries for non-production staff. For instance, these would cover administrative salaries, employer national insurance, premises insurance, travel cost, office supplies, rent and rates and marketing expenses, heat and light, postage, subscription, legal and accountancy fee, charitable donations, phone and internet, lease rent, hire purchases, repairs and renewals. Operating profit, or EBIT, which stands for earnings before interest and taxes, is the profit a company generates from its core operations before any interest and tax deductions. The formula for calculating operating profit is quite straightforward. It's gross profit minus operating expenses. Other income and gains refer to any income or gains from activities outside the normal course of business. This could include things like interest income or gains from the sale of assets. For example, interest income or gains from asset disposal would fall under this category. In the UK, HMRC requires interest income and gains from the disposal of assets to be reported separately in the corporate tax computation. By clearly separating these items in the income statement, it simplifies the process of preparing the tax computation and ensures compliance with HMRC reporting requirements. This also helps avoid any confusion during tax filing, making it easier for you to correctly calculate and report the business's taxable income. Finance costs refer to the interest paid on borrowed funds, such as loans or bonds. For example, this includes interest on bank loans and interest payments on bonds. The HMRC requires interest expenses to be recorded separately in the corporate tax computation. By clearly separating finance costs in the income statement, It simplifies the process of preparing the corporate tax computation, ensuring accuracy and compliance. Recording interest expenses separately will help streamline tax calculations and make your tax reporting process much more efficient. After deducting net interest expenses, you will get profit before tax. The amount of tax the company has to pay is based on its profit before tax. Examples of tax expenses include corporation tax and VAT penalties. Once we deduct taxes from profit before tax, this will give us net profit or loss in case of a loss. It is the bottom line of income statement. Why is the income statement important to various stakeholders? Tax authorities are highly interested in the income statement as it gives them insight into the profit a business has made. The reported figures determine the amount of corporation tax the business will owe. The income statement also plays a crucial role in helping authorities such as the HMRC identify any unusual expenses or potential tax evasion schemes. By properly categorizing expenses, it ensures transparency and prevents misclassification. For instance, while it might seem easier to pool all expenses under one broad heading, doing so can create significant confusion. It's essential for business owners, regulatory authorities, and auditors to see a detailed breakdown of expenses to ensure each one is allocated to the correct category. This detailed classification is not only important for compliance, but also facilitates the harmonization of income statements globally, making them easier to read, understand, and interpret. It also helps auditors and HMRC to scrutinize the expenses claimed by a business, like large claims for office expenses or entertainment, to ensure they are legitimate and business-related. Shareholders and management also rely heavily on the income statement to assess the financial performance of the business, enabling them to make informed decisions. By breaking down expenses into specific categories, it allows them to closely analyze where money is being spent. This detailed analysis helps management identify and avoid unnecessary costs, which in turn improves profitability. The ultimate result is an increase in profits, potentially leading to higher dividends for shareholders and better overall financial health for the business. Employees may be interested in the company's financial health through the income statement, as it could influence salary increases, job security, and potential bonuses. A profitable company is more likely to provide benefits and financial stability for its employees. For example, profit-sharing schemes or performance bonuses may depend on the company's profitability as reported in the income statement. Summary: key components include revenue cost of goods sold, gross profit operating expenses, operating profit or EBIT, other income finance costs, profit before tax expense, net profit or loss and earnings per share, stakeholders' interest. Tax authorities use it to assess taxable profit and verify expenses. Shareholders use it to determine financial health, profitability, and the potential for returns. Employees use it to gauge job security, salary adjustments, and performance bonuses. Understanding the income statement is crucial for businesses to manage finances effectively and ensure compliance with tax regulations. By accurately classifying income and expenses, businesses can minimize tax risks and provide a true reflection of their financial position, benefiting both internal and external stakeholders. For accountants, staying informed and maintaining attention to detail is essential, not only to ensure compliance, but also to enhance employability and career progression. Thank you for watching. Stay tuned for more insights, and don't forget to like, subscribe, and leave your comments below.